Okay, guys, this is going to be a deep one and a bit geeky. It's about bond markets. So, why is there so much talk about bond markets lately? I know it sounds boring and a bit snoozy, but bond markets are a barometer for economic confidence. And right now, the confidence is looking a little bit shaky. And what happens in the bond market could potentially affect you more than you think. So I'm going to try to explain this to you so you understand why it matters in the big picture. So what's been happening? We've all seen the roller coaster week in stock markets around the world, right? So when there's economic uncertainty, investors cash out of stocks, stock markets go down, that's expected. But normally investors shift from stocks and buy bonds because bonds are seen as safe, steady investments in times of turmoil. The US Treasury bond in particular is seen as one of the safest investments because it's paid by the US government, which has never defaulted. Plus, the world sees the dollar is stable, the US economy is strong. But this week, investors sold off stocks, as you saw, but they're also started selling off bonds. And that was the alarm bell because US Treasury bonds are safe havens. So dumping them is like bailing out of a lifeboat. That rarely happens. In recent history, there are just a few notable times when investors cashed out of both stocks and bonds. The 2008 financial crisis, the start of the pandemic in 2020, and the UK had a mini budget crisis in 2022. So in short, this kind of sell-off only happens when there's major financial anxiety. So what happened this time? On the 9th of April, investors started selling off both stocks and bonds. Why? It could be several things: fears of a recession, concerns about inflation because of the tariffs. Also, it signifies that investors are starting to question the stability of the US economy. And that's what's worrying for the US, because if the US loses its reputation as the world's strongest economy, that would be a huge global shift. And some analysts think this week's shaky bond market may be part of the reason that Trump put some tariffs on hold, although that's not stopping the trade war with China. So if you want to follow the bond market, how do you do that? I'm going to give you some geeky technical stuff to help you, starting with the definition. What is a bond? A bond is basically an IOU issued by a government or company. It's a way for them to raise money. So when you buy a bond, you're essentially lending that company or government money. And in return, they promise to pay it back with interest over a set time. So a US Treasury bond is an IOU from the US federal government. Now, who owns these Treasury bonds? The majority are owned by institutions and individuals in the US, but a significant portion is held by foreign countries. According to the US Treasury, as of early 2025, the top foreign holders of US Treasuries are Japan, China, the UK, Luxembourg, and the Cayman Islands. So over the past week, there was speculation that China might be selling off some of its US Treasuries because of all the trade tension stuff, but there's no concrete evidence of that. So to follow the market, don't just look at the prices, look at the yield. Now, yield is just a fancy word for the return you're getting for buying that bond. It's your reward for lending money. So a higher yield means a higher reward for your money. Now, usually in times of uncertainty, people rush to buy treasuries because they're seen as super safe. People trust the US economy. But if that trust is shaken, investors want more rewards to buy those bonds. So bond prices go down, but the yield goes up. That means the US government has to pay out more, and that's what can affect you. More tax dollars go toward paying interest, and less goes to things like healthcare, education, infrastructure, or it may mean taxes have to go up. So how could that affect you day to day? Well, bond yields affect bank lending rates. When yields go up, borrowing costs go up, on things like mortgages, auto loans, credit cards. And for businesses, it costs more to borrow money. So that means less cash for hiring or investing, fewer job openings or smaller paychecks. There's one other issue. Right now, the US has around $36 trillion in national debt. So if those bond yields keep going higher, it's going to be more expensive for the US government to pay off that debt. That's just a side note, but it's important. I know this seems a bit doomy gloomy, and to be fair, it is a little scary. So here's a panda photo because I think we all need that. Anyway, so that's it for this edition. These are just some basic facts. You can read and learn a lot more on your own. In the YouTube description of this video, you'll find links to the sources I mentioned. You can check them out for yourself. And please feel free to question me, correct me, suggest new info. This is a dialogue, not a monologue. I'm doing this because it's my job to go through this type of information every day. And I know it can be a lot to sift through. So if you follow me on Instagram, I post daily updates on my stories. But my intention here is to give you the building blocks, to empower you, to engage, and to do your own research. And if you find this helpful, you can subscribe to my YouTube channel, and then you won't miss anything coming up.